Assalamualaikum and good morning. Okay, class, we will continue our topic with financial crisis in advanced economies. So, advanced economy is a term used by International Monetary Funds to describe the most developed country in the world. Okay, so what to learn from this topic? Okay, there are five subtopics will be covered. The first one is how asymmetric information explain banking regulations, political economy of the banking crisis, why a banking crisis occurs in 1980s, 1990s and 2000, dynamics of financial crisis in advanced economies and dynamics of financial crisis in emerging market economies. So in this chapter, we developed a framework to understand the dynamics of financial crisis based on the three questions raised. Why did the financial crisis occur? Why have financial crises been so prevalent throughout world history? Why are financial crises almost always followed by severe contractions in economic activities? Okay, let's move to the first subtopic about how asymmetric information explain banking regulation. So the first one is government safety net and deposit insurance. Because of the government needs to prevent the bank run due to asymmetric information. Asymmetric information is already discussed in the previous chapter. Okay, hope you guys still remember of that. So depositor can tell good from bad banks. Create moderate incentive for banks to take and too much risk, create adverse selection problems of crooks and risk taker wanting to control banks. Okay, moral hazard and adverse selection is the problem that occur under asymmetric information, which is the adverse selection is occur before the transactions and moral hazard is occur after the transactions. Okay, and then too big to fail increases moral hazard incentive for big banks. Okay, the more big of that bank, the more risk will be occurs in that bank. Okay, the second one is restrictions on asset holding, reduce moral hazard of too much risk taking. Okay, and then bank capital requirement, reduce moral hazard. Bank have more to lose when have higher capital. Okay, bank supervision, charterings and examinations, reduce adverse selection problem of risk taker or crooks owning banks, and then reduce moral hazard by preventing risk activities. Okay, and then disclosure requirement, better information, reduce asymmetric information problems. Okay, and then the new trends, we call it the assessments of risk management using RMA, which is a risk management assessment, is the first steps in developing comprehensive risk management program by the banking sector. The RMA identifies, analyze, and report on an organization's material risk exposure. It provides a multi-dimension view of risk, taking into account organizations' wide enterprise risk and specific insurance-related exposure. What is the organization's wide enterprise risk? Is the decision across the organizations are within and aligned to the nature and levels of risk that stakeholders in the organizations are willing to take. Okay, so these are five steps lies under the RMA. Okay, the first one is get to know the organization. Okay, gather as much information as possible to learn about organizations, establish objective and review a timeline for completions of RMA. And then the second one is examine risk management technique, which is take a closer look at the existing insurance coverage, what losses have been experienced, and organizational total cost of risk, as well as the risk management best practice currently in use. And then the third one is identify and analyze exposure, which is a series of questions designed to uncover risk exposure and prepare an action plan to protect against this risk. And then the fourth step is implement the plan, which is address gap in insurance, finalize loss reserve reviews and procedures, and set a strategy for improvement. Okay, and the last step is monitor results and provide support, which is form a work group with a member from organizations and provide ongoing guidance on risk-related issue. Recommend action that support continue total cost of risk improvement for the banking sector. Okay, so this is the 5 RMA that have been used in the banking system. Okay, and now let us look what is the political economy of the banking crisis. Okay, politician is always influenced by bank lobbies rather than the public. Okay, and then they will deny fund to closed bank. Deny fund from the closed bank means the politician which is influenced by the lobbyists, they will deny the fund that let the bank close due to some bad experience of that bank in the past. Okay, and then the legislations to relax restrictions means when the restriction relaxes or loose, it will create the asymmetric information. Okay, and then the second one is regulator influenced by politicians and desire to avoid blame. Okay, loosen capital requirement, regulatory restrictions on risky asset holdings, and regulatory forbearance. Okay, what is the regulatory forbearance? Forbearance in the context of mortgage process. Okay, mortgage means the loans of housing loan, for example. Okay, it's a special agreement between lender and the borrower. Lender means the bank sector or the bank, and the borrower is the us lah. It's about us. We borrow the money to buy a house from the bank to delay a foreclosure. The literal meaning of forbearance is holding back. When mortgage borrowers are unable to meet their repayment terms, lender may opt to foreclose. To avoid foreclosure, the lender and the borrower can make an agreement called forbearance. According to this agreement, the lender delays its right to exercise foreclosure if the borrower can catch up to its payment schedule by a certain time. This period and the payment plan depend on the details of agreement that is accepted by both parties. Okay, forbearance meaning the delay payment from the borrower to the lender. Okay. Okay, look at why the banking crisis occurred in 1980s. Okay, at the early stage, manager of the bank did not have the required expertise to manage risk because at this time the RMA is not implementing yet. Because of the lending boom, okay, meaning that the lendings or the loans at that time increased, bank activities were becoming more complicated. Okay, regulator had neither the expertise nor the resources to monitor these activities appropriately. Okay, so when the profits of the bank increase, it will increase the interest rate, and then the net worth of the bank will be decreased. Okay, and then it will increase the insolvency. Insolvency is the state of being unable to pay the debt by a person or company at maturity. Those in a state of insolvency are said to be insolvent. There are two forms, cash flow insolvency and balance sheet insolvency, meaning that insolvency increase means the debt or the unpayment or NPL, non-performing loans of the bank will be increased. Okay, incentive for risk taking will be increased. Okay, so the result will create the higher failure and the risky loan will be increased. These are all because of the asymmetric information occurs in the banking sectors during this time, 1980s. Later stages, regulatory forbearance Okay, regulator allow insolvent banks to operate because insufficient funds and swept problem under the rug. Okay, that is why the banking crisis in 1980s occurred. Okay, because of the expertise or the management of the risk of the banking sector is still lack at this time. Okay, look at the financial crisis occurred in 1997. Okay, uh, that affected many Asian countries in July 1997. Okay, the Asian countries affected by Thailand, South Korea, Malaysia, Indonesia, Singapore, and the Philippines. The crisis originated in Thailand. Okay, Thailand's currency baht collapsed in July 1997, which is Thailand had a fixed exchange rate system. It had pegged the value of the currency to the US dollar. But in July, the government was forced to float baht due to speculative attacks on the currency. Speculative attack means at this time the speculator named George Soros speculate the baht currency until it forced to float, and then the value of the currency declined and the stock market tumbled and the crisis spread to other Asian countries. Okay, that is the crisis occurred in 1997. We call it the financial crisis, but in 1980s we call it the banking crisis. Okay, so that's all for the first part of this topic. I will continue the second part later. Hope to see you again.